You did everything your parents told you to do with money. You got a stable job. You put 10% of every paycheck into savings. You avoided debt like it was fire. You waited patiently because someone once told you that patience and discipline were the whole game. It's 2026. You check your bank account. The number is smaller, in real terms, than it was 5 years ago. You did everything right. So why does it feel like you're falling behind? Here's the problem. Those rules weren't wrong. They were built for a different economy, one that no longer exists. Think about where those rules actually came from. A stable job for 30 years, a modest house at 25, a pension waiting at the end. That playbook was written in the 1950s and 60s, when a single income could support a family, when interest rates rewarded savers, when a company actually kept its promise to pay you for life. Your parents, or your grandparents, didn't invent those rules. They inherited them from an economy that has since been dismantled, piece by piece, and nobody sent out a memo. Start with the pension. In 1978, the United States Congress quietly added a new section to the tax code, Section 401(k). It was never meant to replace pensions. It was a minor tax provision. But companies realized something within a few years. It was far cheaper to hand employees a 401(k) and let them manage their own retirement risk than to guarantee a paycheck for life. Within 2 decades, traditional pensions had nearly vanished from the private sector. The rule "your company will take care of you" quietly became a myth. Nobody rewrote the old advice. It just stopped being true. Now add Daniel Kahneman to the picture, the psychologist who won a Nobel Prize for showing how humans actually make decisions, not how economists assume they do. Kahneman's research on status quo bias found something uncomfortable. Once a rule gets set early in life, especially one taught by a parent or an authority figure, people keep following it long after the conditions that made it true have disappeared. Not because it's still smart. Because changing course feels like a loss, and Kahneman showed that losses hurt roughly twice as much as equivalent gains feel good. So you keep saving the old way. You keep waiting for the old system to reward you. It's not stupidity. It's wiring. Then there's Ray Dalio, the investor who spent decades studying something most people never think about: long-term debt cycles. Dalio's research traces roughly 50 to 75-year waves where entire economies shift from cheap credit and rising asset prices to overloaded debt, aggressive money printing, and currency devaluation. His argument is that we are deep inside one of those late cycle shifts right now. Cash sitting quietly in a savings account isn't neutral in a cycle like this. It's a bet, and a bad one, on the value of money staying still while everything around it moves. One more data point, and this one you can feel in your own life. The 2008 financial crisis didn't just wipe out home values. It rewrote what stable job and safe bank meant to an entire generation watching it happen. Trust in the old institutions took a hit that never fully recovered. And the Federal Reserve's own survey of consumer finances, tracking American households for decades, shows the same widening gap every cycle it runs. Wages inch up, while the assets wealthy households hold, real estate, equities, ownership stakes, climb several times faster. The old rules assumed those two lines moved together. They stopped moving together a long time ago, and almost nobody updated the advice to reflect it. So let's actually walk through what happens when someone follows the old rules to the letter, right now in 2026. You take the stable job. Except stability isn't what it used to be. Entire departments get restructured every 18 months. Skills that took you a decade to build get automated in 18, as AI tools quietly absorb tasks that used to require a full-time hire. There's no pension waiting at the far end of that job anyway. So stay loyal for 30 years isn't even a trade you can make. You save your 10%, diligently, into a savings account, paying a fraction of the rate that inflation is quietly eating. Every year, that money buys a little less than it did before, even though the number on the screen goes up. You avoid all debt, because debt was framed to you as the enemy. But the house prices around you have grown far faster than wages have for decades, which means the version of save up and pay cash that worked for your grandparents would now take you most of a working lifetime to pull off. You wait for the pension. There isn't one. You wait to feel caught up. You don't. Picture the actual Tuesday this produces. You wake up, check your phone, see a headline about layoffs at a company that looked untouchable a year ago. You open your banking app out of habit, not because you expect good news, just to confirm the number you already guessed. You transfer your usual 10% into savings, the same motion you've made every payday for years, and you feel a small flicker of pride, because you were told this is what responsible people do. Then you close the app and go back to a job you're quietly unsure will exist in its current form in 2 years. None of that is a personal failure. It's what following a 60-year-old checklist looks like when the economy underneath it has been swapped out. Here's the counterintuitive twist. The behavior that felt the safest, saving cash and avoiding all debt, has quietly become one of the riskier paths available to you. Not because saving is bad. Because doing it exactly the way it was done 60 years ago, in an economy structured completely differently, means the safe choice is now the one guaranteed to lose ground to inflation and rising asset prices every single year. This doesn't mean the old rules were nonsense. Thomas Stanley, the researcher behind The Millionaire Next Door, spent years studying actual American millionaires and found that most of them really did live below their means, avoid flashy spending, and save consistently. That part of the old advice holds up. What Stanley's data doesn't show, because most of it was collected decades ago, is where those millionaires put the money once they saved it. Overwhelmingly, it wasn't sitting in a savings account. It was in ownership. Businesses, real estate, equity, appreciating assets. The discipline was old school. The destination for the money was not. That's the piece that got lost when the old rules got passed down. Save consistently. Yes, still true. But the version of, then put it in the bank and wait, quietly stopped working while everyone kept repeating it out of habit. So picture your actual life today, running on the settings your parents installed. You check your account on payday. The math almost works, but not quite. Rent or your mortgage eats a bigger share of your income than it did for the generation before you. Your savings account balance climbs a little every month, and somehow you still feel behind. Because in real spending power, you often are. You've done the disciplined part. Nobody updated the instructions for where that discipline should actually point. Here's the mirror. The old rules were never really about a specific job, a specific house, or a specific bank account. They were about a relationship between effort and reward that assumed the system would hold its end of the deal. The system changed the deal. It changed the pension. It changed the value of cash sitting still. It changed how fast housing and wages grow relative to each other. What it didn't change is the appearance of the old advice, which is why so many people are still quietly following instructions written for a world that no longer exists. Ask yourself which parts of your own financial routine are actually decisions, and which ones are just inherited habits nobody re-examined. Did you choose a savings account because you compared it against other places to put your money, or because a parent once told you that's where responsible money goes? Did you choose to avoid every form of debt because you ran the numbers, or because someone used the word debt the same way they'd use the word fire? Kahneman's whole point was that most people never notice the difference between a decision and a default. The default just feels like common sense, right up until you check whether it's still true. The fix isn't abandoning discipline. Burton Malkiel, the economist behind A Random Walk Down Wall Street, has spent decades showing that consistent, boring investing, small amounts done regularly, in ownership of real assets rather than cash, is one of the few strategies that has reliably outpaced inflation over long stretches of time. That's not a new rule. That's the same discipline your parents taught you, pointed somewhere the last 60 years of economic evidence actually supports. You check your bank account on payday. The number is still smaller, in real terms, than you'd like. But now you know the discipline was never the problem. The instructions were just written for an economy that already ended. And it's on you, not your parents, to write the next version.